the US can essentially vampire attack the rest of the world with low property rights for the benefit of these savers. Because now you're, again, Nigeria, Brazil, Argentina, pick a country, and instead of saving in fiat and local equities, you just go on chain and you save in USD, USDC or USDT, and you save in Apple stock or Nvidia or the S&P or the Nasdaq, and that just means you go from losing 65% relative to the dollar every 15 years to gaining, in the stock market's case, 8 to 12% a year. It's a massive difference in the ability of these people to save.
Hey everyone, this episode is brought to you by Uniswap Labs, who is launching the largest bug bounty program in the entire history of crypto. It's a $15.5 million program. This is aiming to be the most rigorously reviewed code base ever deployed to Ethereum. So if you want more eligibility on the scope, rewards, payouts, etc., just click the link in the bottom of the show notes, tell them that I sent you. You'll be hearing all about Uniswap Labs later in the program. Hey everyone, this episode is brought to you by Morpho, the sleeping giant of DeFi, is what some people are calling them. That is me. I am some people. I am a huge fan of Morpho, the protocol, and the team. You've heard Paul Frambeau, one of the founders of Morpho, on the program before. Morpho lets you earn, borrow, and build on your terms with better rates for lenders and borrowers and an immutable design free from upgrades or parameter changes. You're going to be hearing all about Morpho later in the program, but for now, let's get on to the show. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another episode of Bell Curve. Today, I'm joined by Felipe of Theia Research. Felipe, welcome to the program.
Good to be here. I'm a big fan of the pod.
Thanks, man. First episode of the year. Save the best for first, as they say.
That's right. That's how that saying goes.
Yeah, dad jokes too. But jokes aside, I'm actually really excited to talk to you today. So you dropped something in the Left Curvers chat, which that's a plug, by the way. If there's a Bell Curve Telegram chat, we'll link it in the show notes. So you definitely go hop in there. But you posted one of the first things of the year. So this new piece that you wrote called Internet Finance. And the reason I like this is because, most of us are probably coming back from the holidays. We spent some time with family, probably ate too much food. And if you've been working in crypto for a while, people ask you, so what is this crypto thing again? And I have always struggled with this question. And I used to just rely on the Bitcoin explanation because it's the monetary one. It's the most well-trodden. Everyone kind of gets the gist of it in general. But to me, crypto is much more than just a monetary aspect. There's a financial system aspect as well. And I think this piece did enormously well outlining some of the core components of how you think about a crypto native financial system might work versus what the TradFi financial system looks like today. And so maybe you could just talk a little bit about the motivations of writing this piece, and then we can get into some of the nitty gritty about what's actually included here.
It's exactly what you said. I mean, we've been at this for 3 years now. I've been obsessed with the kind of financial thesis within crypto for that period. I talk to my friends and family about it endlessly, and I get the nagging sense that they don't really understand what I'm talking about still. And it's hard. It's been hard to express it, honestly, for me. So I said, this December, we'll put pen to paper, really try to make it clear what we're building, and write a piece that hopefully my mother and my wife can understand, and kind of come into the shared vision that we're all trying to build here, that we all kind of understand, but maybe haven't had enough resources to kind of communicate.
Yeah. All right. I want to get into the meat of the piece here. And the foundation of the piece for me relies on a little bit of a technical distinction, but I think it's an important one. So, what you describe as unified servers and smart contract code. So unified servers versus more disparate heterogeneous groups of servers. And then that leads into 5 benefits, right? So the 5 benefits are free flow of capital, stronger property rights, more innovation in terms of financial services, more efficiency in terms of financial services. And we can talk a little bit about stable coins and US-based assets there, et cetera. And also net interest margins business and compressing net interest margins. And then faster GDP growth. So those are just to signpost for the audience a little bit. Those are some of the benefits. But first, explain this idea of unified servers and why that's so important within a crypto context.
Yeah, that's the most technical part of the piece, but it's also the most important. I think almost nobody thinks about what it means to hold an asset in a financial system or in the current financial system. You kind of have your Apple stock on Robinhood. That's enough for you. If you really boil it down to what it means to own something, it means that you have your name and the asset and quantity in a ledger. And these ledgers or these servers, is what we call them in the article, are really fragmented, disparate, and permissioned across the financial sector. So if you going back to the kind of Robinhood example, if you and your 9 best friends each own 10 shares of Apple on Robinhood, that means that Robinhood, the company, has an internal server that says, Mike, 10 shares of Apple, your 9 best friends, 10 shares of Apple. Then Robinhood itself has 100 shares at a custodian. Apple itself has, 100 shares at a custodian like BNY Mellon. So BNY Mellon has a server that says Robinhood, 100 shares of Apple. And BNY Mellon itself has its shares at a DTC company. And that DTC company is the official ledger that interacts with Apple's Treasury Department and CFO. So it's kind of these like just something as simple as holding Apple share. You kind of have these 3 or 4 disparate servers. And transferring from Robinhood to Fidelity is painful because all those servers in the back end need to talk and agree with each other. And it's the same across all assets. So 2 quick examples. If you have $10 in Bank of America has a server that says Mike $10, and the Fed has a server that says Bank of America $2.4 trillion, right? And that's the way that works. The Fed can't peer into your Bank of America account unless they ask for that information from a fragmented, disparate server. And the problem gets a lot worse once you kind of go around the world. Final example: if you own land in Brazil in a municipality outside of Sao Paulo, there'll be a physical office that has paper records with kind of latitude and longitude, and that'll say, Mike owns this piece of land, and whoever has that name in that server is the controller of the asset. So what I'm trying to paint is this picture of like there are 90,000 approximately financial servers around the world. Some of them are paper, some of them are databases, and they need to speak to each other. And it's kind of this cumbersome morass of difficulty to communicate. And what we're building in crypto is this idea of a unified server that's all and a unified permissionless server. Because instead of having the Robinhood, BNY Mellon, Bank of America administrators change the transactions, anybody can send a transaction and change the state of the ledger. And that's makes a whole difference. And that's the foundation of how these kind of 5 benefits are possible.
I want to set up the way that I sort of look at this, which is I think from a high level, what a financial system is supposed to do is to facilitate commerce, right? And there are different components of that. Parts of that is making sure that capital flows where it's supposed to go, right? To where the highest returns are. And so obviously there's a part of crypto which is very global. So you open it up to a much larger base of investors, right? So it does that part a lot better. The other thing that I think a financial system is supposed to do is to make it fair, right? And have there be strong property rights, right? So that if you're, building a business or investing in land or whatever it is, that's not going to get ripped away from you. And so, part of the fragmentation of these different servers is it affords, people that have big servers in local jurisdictions the ability to actually cheat. And so kind of the architecture of crypto incrementally is beneficial for facilitating commerce, by opening it up to this larger global base of investors and having more free-flowing capital, but also it makes it harder to cheat. Is that roughly a good way of describing things?
That's right. And those are the 2 major benefits for emerging markets, where I think a lot of this technology is really helpful. But emerging markets, isn't some offshoot. It's kind of 5 billion plus people around the world who struggle with both of these issues. So the first one that you mentioned is what we call the net interest margin problem. So because you have these permission siloed servers, if you want to lend, or a Dubai fund that has an 8% cost of capital wants to lend to a Colombian mortgage at a 20% yield, they can't just go and do that. There's no way for the Dubai fund to access the permission server and pay out that loan, right? The fragmented web is just too botchy. So what ends up happening is that there are local banking oligopolies, and they tend to be oligopolies in most countries, where 5 banks basically control the permission servers within a geographic region, and they act as gatekeepers within that region for opportunities. I think that, you're putting this chart on the screen. It says market share for 5 largest banks. These are the most populous countries on earth, and it's basically above 50% market share in all of these jurisdictions, right? So these 5 institutions they get to decide what capital comes in, what capital stays out, and they do what
which are
every
heavily
government
connected to governments, right? I mean, essentially,
force.
JP Morgan and Bank of America are extensions of the US government. They're so heavily regulated.
Well, that's right. Part of my experience with this is I used to do my side trading in EM banks when I was in my prior job, and I had a family member who did that full time and was very good at it. The first thing he would look at when he was looking at a new bank is the cap table to see what the overlap was with the local government, because that was the best predictor of returns for a bank. So there's always that kind of government bank intertwined element.
Interesting.
Uh,
Yeah.
so these banking sectors, they have gatekeeper access to the banking system, right? And what they do is what every kind of monopolist or oligopolist does, which is under provision and overprice. You don't give out as many loans as you should, and you raise the price on the loans that you do give out, and that's the revenue maximizing position for this market structure. So that leads to the NIM problem, which is the regression that you had below, where if you look at how developed a financial system is, how linked it is to the rest of the global economy, and the net interest margin, which is the difference between what a bank borrows at and what it lends at. It's kind of a pure metric for bank pricing power. Less developed countries can have up to 5 to 10 points higher NIM. That's actually the average. They can be much higher than that. 5 to 10 points of higher NIM is really a disaster for an economy, because capital is the basic input to everything that goes on in an economy. If mortgage rates are 5 to 10 points higher because of the banking structure, that means housing prices are lower, less houses are sold, housing prices are lower, less houses are built. That means a small or medium business loan is 5 to 10 points more expensive. Fewer businesses are started. The economy grows less quickly. Fewer people are employed, and you can run that playbook across the entire economy. So this only exists because of the permission siloed server problem. Once you have a unified server where anybody can compete for capital, you have that Colombian mortgage go to the internet, go on chain for financing. You have the Dubai fund that's at 8%, give them financing. You collapse the NIM, and you basically solve this problem by truly making capital a globally competitive market instead of a siloed market.
Mm. So, you know what? One thing that I'm curious about, and I want to get into the segment here where you talk about the benefits of basically US dollar denominated assets, stablecoins for the most part, and where that fits into this internet finance world. Because, um, I, one of the I wonder what the business opportunity is, right? It sounds good, and I think that we all want to live in a world, right, where if there's capital in Colombia and there's a lower cost of capital in some other country, like you can lend to basically do more peer to peer kind of small business type lending. I guess I do wonder how big is the market for that really, and how much more is the market opportunity here for like if you're living in Venezuela or Turkey or a country which is hyperinflating their currency away, can you very easily hold money in something which is a USD denominated asset and not just get devalued
Yeah,
increasingly? So, how do you kind of divide up the opportunity in terms of what this open internet financial system enables?
yeah, and this is the point that we like to make, which is let's start with underserved markets. It's kind of this Clay Christensen point of don't go for the overserved markets first. Don't go for the U.S. financial system. Go for underserved markets. And there's nobody who's more underserved than like the Venezuelan saver, right? Or like the Nigerian, Turkish. There's a lot of countries that can go on this list. Savers, they have the problem where one, local fiat is being devalued quickly. We all know this in the space. The average currency for the 15 most populous countries in the world is being devalued at 65% relative to the dollar over 15 years. So this isn't even Bitcoin. It's not even hard money. It's just relative to good old USD. You're losing 65% of your purchasing power over 15 years. So you can say, why don't they save in another asset? And that goes back to the property rights question that you had brought up. I think there's a chart in here that shows property rights around the world. Again, just emerging markets sorted by population. And what it shows right there, and what it shows is you have the US at 95. Most of Europe and Australia are close to 95 on a property rights score. That means, your assets are safe. If you own something, that means you truly own it. That it can't be taken from you or expropriated. If you go to court, the court will be relatively fair or judge a case by its merits. If you're a minority shareholder, the majority shareholders can't just wipe you out. You have some minority shareholder protections. That's what 95 means. And that's what we're all kind of used to in anyone who lives in the US or Europe or Australia. The rest of this chart is kind of emerging markets by population. It covers 5 billion people, and they're at a score of 49. 49 means kind of the opposite on all dimensions. If you have property for now until somebody decides, somebody with political power decides to expropriate it, or you have land in this kind of in Brazil that's saved in the local municipal office, and the land goes up in value dramatically, and you find out that the governor's brother found his way into owning your asset without you even looking. The name was just changed, right? That happens. Or you are a minority shareholder in a big business. The majority shareholder is a well-connected politician or well-connected businessman. He does some move that wipes out your value, or at least really impairs your value. Nothing you can do about it, right? Courts are ruled often by bribes or favoritism. That's what 49 means, and it's kind of, it makes it really hard to own assets. You don't want to own assets in a 49 country in terms of property rights score. So coming back to your question, what does this mean? I think there have been kind of three property rights steps for internet finance. The first was Bitcoin, cloud asset that you can't tamper with. People can own that. If you own your Bitcoin, you own your Bitcoin. That's a property right. Then we get into kind of the real world, because most of the economy needs to be in the real world. It looks like we're starting, a decade here. I hope where the U.S. embraces internet finance and puts assets on chain. We already have 200 billion of stable coins on chain. The stablecoin bill looks likely to pass. I think that in this administration, the government will let Larry Fink put Apple stock on chain. That's for me the single most important step in the development of this whole ecosystem. Is Larry Fink or someone like Larry Fink putting Apple stock on chain, and then what you have is the U.S. can essentially vampire attack the rest of the world with low property rights for the benefit of these savers, because now you're, again, Nigeria, Brazil, Argentina, pick a country, and instead of saving in fiat and local equities, you just go on chain and you save in USD, USDC or USDT, and you save in Apple stock or Nvidia or the S&P or the Nasdaq, and that just means you go from losing 65% relative to the dollar every 15 years to gaining, in the stock market's case, 8 to 12% a year. It's a massive difference in the ability of these people to save.
Yeah, it's a very interesting outcome because on the one hand, I could see lowering friction, enabling more investment into emerging markets. On the other hand, I could also see it almost working the other way, where there are lots of emerging markets which are effectively shutting their citizens access off to U.S. capital markets and U.S. currencies, et cetera. And so there could almost be like a barbell sort of effect as well. And yeah, I think, just to maybe kind of tie a bow on this, I think for me, just the simplest way to think about this is like the unified versus, distributed servers it's just, it eliminates inefficiencies, right? So you can compress those net interest margins, and that leads to more credit being extended to people, and it actually raises GDP, et cetera. And then it also, because everything is connected, everything is just much more transparent. And so it's harder to cheat. So you get stronger property rights, you get more investment, and you get both of these positive reflexive sort of loops. Like that's sort of my takeaway listening to your explanation and piece. But, I want to give you a chance here to tie a bow on it for the listeners.
Yeah.
Like what are, when you're going back, over Christmas or Hanukkah or Thanksgiving or whatever, next year, what should people be taking away?
On the property rights, I think, we just kind of I cut it into phases. Next phase is places with property rights get all the capital. Then there's a reaction function, right? Then these countries with scores of 49 can decide whether they use the tools of internet finance to raise those scores. Because right now it's a little bit like the newspaper local monopoly situation, where if you were in Buffalo in 1970, you read the Buffalo News, and that was it. Buffalo News did not compete with the New York Times. Now every paper competes with every paper around the world, right? And some papers kind of just went out of business and weren't able to compete, but some papers decided to up their game and decide to compete on a global scale. I think that's what we're going to see here, where some countries will say, hey, internet finance really gives us good tools to improve property rights, and the returns to having good property rights have never been higher, because now we can get capital from around the world and really grow quickly as an economy. So just to make that concrete, the land registry example, you can put the land registry on chain. This is an idea that people have had for a few years in the space, but it really does matter. If your land is no longer a piece of paper in an office that you can't access, but it's an NFT that you can look at every day and transfer at will, that's a decision that's hard to reverse. And that's a decision that one reform government can make to strengthen property rights in their country. If a company in Mexico decides to hold stables in a smart contract that has minority shareholder protections baked in, that's hard to reverse, and that strengthens property rights for minority shareholders in that company. So there's all these ways we can use the tools that we have to strengthen property rights, and I think that will be the natural reaction function of these countries once they see the returns, one, the negative returns to low property rights because capital will flow out, and two, the positive returns to high property rights because, emerging markets, all else equal, have higher yields. So if you can strengthen your property rights using these tools, you will get a lot of capital in and grow at a faster pace.
All right, everyone, listen up. Like I said at the top of the episode, Uniswap Labs is rolling out the red carpet and launching a $15.5 million bug bounty. This is the largest bug bounty in the entire history of crypto to anyone that can find a critical bug with the Uniswap v4 protocol. This bug bounty aims to make it the most rigorously reviewed code base ever deployed to Ethereum. Now, the Uniswap name is basically synonymous with security. $2.4 trillion in cumulative volume has passed through Uniswap v2 and v3 without a single hack. So Uniswap v4 is dedicated to bringing that same level of security and transparency to the v4 protocol. So if you want more information or eligibility or scope or rewards or payout or any of that good stuff, there's a link in the bottom of the show notes. I highly recommend that you stop listening right now, go to the show notes, click the link, head over and tell them that I sent you. Start earning money today. Hey everyone, this episode is brought to you by Morpho, the sleeping giant within DeFi, as I like to call them. I am a huge fan of both the team behind Morpho as well as the protocol. Had the CEO on, Paul Frambeau, earlier this year to talk about Morpho's architecture. And the part that I really love about it is the modular design that gives you, the user, either the lender or the borrower, much, much more flexibility. So I'm actually going to share my screen, what it looks like to go onto Morpho, but as opposed to other borrow lend protocols where you basically just have one option, you get multiple different vaults, which are curated by the industry's leading risk assessors. So that could be a vault created by Spark, MEV Capital, Gauntlet, Steakhouse Financial, etc. You have all of these different options depending on what risk return you want to use, anywhere from 9% APY all the way up to 16 or 17%. So you've got a whole bunch of different options there. The other thing about Morpho is that they've got the simplest code base in the entire industry, very, very few lines of code, which means it's a very, very secure protocol. So again, I'm a huge fan of this team. If you are a lender and want to earn interest or you want to borrow in a capital efficient way, I highly recommend that you click the link at the bottom of the show notes, head over and tell them that I sent you. All right, cheers. So we just talked a little bit about at a high level of what, sort of what the point of what we're doing is here, but I would love to get your thoughts on sort of state of the union when it comes to DeFi. And specifically now, I guess if I had to draw a contrast in between 2025 where we are today versus 2022, we've got multiple different ecosystems today. So everything used to be just completely on Ethereum and you had a couple of upstarts. Now you've got Ethereum, but you've also got Solana, which is like arguably kind of the winner of this past cycle and it's becoming Lindy, et cetera. But you also have some new upstarts like the Suis and the Aptoses of the world with Move. And you guys have a very specific focus. You kind of underwrite investments on a longer term time horizon, more like a private equity fund sort of would. And I know you're very focused on DeFi. So maybe just give us a little bit of a, like sort of the investment thesis of the fund and how you guys think about your investable world. And then we can talk about kind of the differences of DeFi today versus 2021 versus 2022 time horizon and what seems interesting to you guys.
Yeah. So we, me and John and Noah are all kind of long-term investors. Our backgrounds are in private equity. I did that for 7 years before starting. And it really informs kind of mid-market private equity where you buy, you kind of buy a company, hold it for 5+ years, work with the management team to pull off a thesis. And your entire return comes from KPI growth during that period. And that's really the thesis that we apply to Theia. It's the fundamentals thesis. We buy liquid tokens with the idea of holding for 2 to 4 years. Slightly shorter than private equity just because the industry moves faster. But the idea is that we shouldn't do better than the KPIs of our companies. So we're never trying to trade narratives. We're never trying to market time. We're just trying to buy good companies with good teams, build a model of what they can do over the next 2 to 4 years, and try and work with teams to help them achieve that outcome. It's my preferred way of investing. It started out as a very contrarian way to invest in crypto. I think it's gaining some at least lip service adoption. There are some people doing it out there as well, but I think it's an easier way to invest, to be honest. You get a lot of false negatives, like there's a lot of stuff that you don't buy if you build a model that trades well in a narrative, but you don't get a lot of false positives. Most of the stuff that you buy, if you're good at predicting it all, um, works out at least decently well, or at least the hit rate is much higher. So, investing is not like Pokemon. You don't have to catch them all in a sense. You just have to get good returns
Mm.
on what you have. So that's the I think the last thing I say about investment philosophy is we really view ourselves as capital allocators. Like the idea of investing is to give funds to projects that deserve funds in your
Mm.
view of the world. So if a project's like well valued or kind of properly understood, there's not really a point in investing because it's the team has all the resources they need, right? And if a team's not going to build something good, regardless of narrative, you don't want to give them resources either, right? Because the limited amount of resources that we have here, it's all about picking people who are kind of undervalued, don't have enough resources and support, but can really build something good here, like going forward.
Mm. But this is something that I know we have talked about a little bit offline, and it's always a fun subject of debate. Do you think this market trades on fundamentals, or how would you balance the more fundamental oriented investor segment of this market versus the more irrational segment of this market? Just walk me through your thought process.
It doesn't trade in fundamentals at all, right? Most traders are not
Mhm.
fundamental traders. There are markets that do trade in fundamentals. Like there are certain segments of, where I used to work in like mid-market private equity, people are all applying the same multiples to the same earnings,
Right.
and they all think the same. So if your business does, if EBITDA goes up 20%, valuation is going up 20%. That's it, right? Maybe there's some kind of macro wiggle room around that. That's not how this market trades at all. But that's why I make the point always about the false positives and the false negatives. If you
Mm.
buy a good business on fundamentals and it grows through a thesis, that investment will do well, right? If you buy something earning 10 million of revenue at 8 times earnings, 80 million, and it goes on to generate 100 million of revenue 5 years later, you're going to do well on that investment,
Mm.
right? Um, One, because if you're buying cheap, narrative usually the only place narrative can go is up, right? Two, because worst case, you just hold it. Right? That's kind of the foundation of fundamental investing is like, are you trying to sell this to somebody or are you trying to hold the asset? And fundamental investing is the kind of leap of faith of saying, I think this asset I think if I hold this asset, I will make enough money to justify my cost of capital from the cash flows. And if it trades up and I sell it, in 4 or 5 years, that's fine too. But I can always just hold it through a market shutdown, 10-year market shutdown. That's like Warren Buffett's question, right? Would you hold this
Mm.
if the market shut down for 10 years? And that question makes you kind of realize how few people are thinking truly in terms of fundamentals, right? Everyone's kind of thinking about selling the asset to somebody else. But just to give you a concrete example of that, like Banana Gun, we bought that, I guess almost a year ago now. We fully paid off our purchase price with dividends on that investment. And
Mm.
that's one of 5 investments where we fully paid off purchase price purely with dividends. So that's the kind of thing that we're talking about here. And you can get that through either buying cheap at the moment or buying cheap looking forward, right? Because even if
Mm.
you buy something that's, maybe it looks expensive today, but you think revenue is going to 10x and dividends are going to 10x, and you'll pay off your entire investment in year three. That's fundamentals as well, right? It's a go forward basis, but it's about holding the asset, not selling the asset.
Okay, I've got a question for you on that. So this is also one of the age-old debates that people love to hem and haw over, but there's this idea of dividending out capital to either token holders or shareholders or whatever, and at what life cycle or what stage of the life cycle of a protocol or company is it appropriate to do that? And
Yeah.
this debate comes up all the time in crypto. Usually it's over DAO treasury spending or something like that, and something to the effect of, hey, there's a lot of silly spending going on, and if we're going to spend money in a silly way, we might as well give that capital back to token holders. And then there's I would say, a smaller group of people which say, hey, hold on a second. the whole point of being an early stage product is that you should have a lot of organic growth
Yeah.
opportunities to allocate that capital to. And if you can't get a higher ROI return than returning capital to token holders, why would you do it? So where do
Yeah.
you fall on that spectrum and debate? And then I'd be very curious to get your opinion on, obviously you guys underwrote an investment or went into Banana Gun with the idea that you were going to get dividended out capital. So walk
Yeah.
me through your thought process there.
Yeah. So I'm closer to the latter group than the former, but there's actually a
Mm,
great book, which I don't know if you've read The Outsiders by
I
Thorndike.
haven't, no.
It's
Yeah.
a really good book. I think you would really like it. It's a book on capital allocation that kind of goes through, it's like in the Buffett school, capital allocation, goes through 10 examples. Again, I think you'd really like it. But basically, it's a matter of capital allocation. Both answers could be right. What you need to do is kind of greedy sort the best use of capital. So you know, if you are if you're Sweet Green and every new store you build gives you 45% cash on cash returns, you know your investors can't earn a 45% return on the stock market. So you're going to keep that cash and invest it yourself, right? Same thing has been true for the expansion of most compounders in business, like Google, Apple, Amazon. They're all earning well over 40% returns on expansion dollars. So they kept those dollars inside. If you are a tobacco company or paper company, and you're not really growing, your capital is not helpful for you, and you know that the marginal project that you can invest in gets you 8% return, then you say, well, look, that's not a good return. I'd rather give this capital back to my shareholders and let them allocate it. So it's like sending the dollar to the person who can allocate it at the highest rate of return on just a basic greedy sort. So the reason most SaaS businesses and early stage startups have always found it better to keep money in house because they're earning these kind of high returns on customer acquisition spend or on expansion. Crypto protocols have this kind of magical ability to scale almost, where if you're making $100 million a year, you might not need all that capital, right? You might if you have a good roadmap and you can really spend that capital. Like if Athena put on your roadmap, I'm sure they believe that's going to be a higher than 40% return use of capital. Like they should go keep every dollar and pursue that roadmap, right? But if you're maker 2023 and you're making above $100 million a
Mm.
year and you don't need all that money for your expansion plans, buy back shares or pay out dividends. It's the same thing, right? So that's all it is. It's just a greedy sort of who can spend the capital at the best rate of return and get the capital into that person's hand.
Yeah, it's an interesting, we've taken for granted that VC is the right funding model for every startup, and I wonder if it is. The small bit of experience that I have with this is that Blockworks is we started as a media business primarily, and we
Yeah,
bootstrapped it. And I will go to my grave saying that VC is the wrong funding model for media, because the time scale that you need to operate on are fundamentally incompatible. Like, you, as a media
yeah,
company, you're building trust, and it's kind of that expression, 9 women can't make a baby in 1 month. You have to do it
yeah,
over time. It just takes a little bit of time, and VC demands that you grow at an extremely fast rate. And so you saw in sort of the early to mid aughts, all of these new digital media darlings, the Vices of the world, the BuzzFeeds, et cetera, just fail for other reasons as well, but largely for that reason too. And if you think about what some of these protocols are, especially in the DeFi world, they kind of look like banking protocols. Not
yeah.
exactly, obviously, there are big differences there, but they look semi like financial services banking type entities. And kind of interesting question to ask yourself: is a VC funding model the right? If you were starting a bank today, would you go to a VC to fund it? I don't think so.
Well, no. Funny thing is, the best bank investor in over the past 100 years has been kind of Warren Buffett, Charlie Munger, Berkshire Hathaway, and
Right.
they said that their number one red flag is a bank that's growing too fast. If a bank
Yeah.
grows too fast, they know it's bad loans, right?
Mm.
So I think that goes directly to your point of saying, like, it's not the same with protocols, but that goes directly to your point of saying VC is not the right funding model for everything. I mean, also in the fund space, like most funds are bootstrapped. We're bootstrapped as well. Um, VC tells you to be a lottery ticket in like the Peter Thiel sense, where
Yeah.
they're okay if you fail, but they want you to get they want to get VC return outcomes, 20 plus
Right.
returns, 20x, 40x plus returns. if I knew a fund was VC backed, I would never put $1 of capital with them, right? Because what are you saying? You're saying take max risk, lose all of it in 90% of the outcomes. In 10%, you're the best returning fund of the year, and then you get to double next year and do it again. So I
Mm-hmm.
think there's just so many cases where VC is not the right model. But that comes back to internet finance, right? Let's really open up the bazaar here and let everybody find the right funding model for their business.
Yeah. One of the other things too that I've thought about when it comes to crypto is highly cyclical, and
Yeah.
um, tech for the last 20 years has not been cyclical. People push back on me whenever I say this, but okay, I mean, just look at the chart for B2B SaaS over the last 20 years, a straight line up, and with 2022 being an exception, and um, there are industries actually that are built like there's a whole sector of the economy like cyclicals, right? Sorry, construction, semi, etc. And I've wondered for a little while if it's kind of like the VC funding model of just apply a whole bunch of capital and grow as fast as you can, but also basically take a lot of risk and lever up both kind of operationally, put a bunch of headcount in there. Those lessons sometimes come back to bite you when it comes to crypto in general. And actually the teams that make it are the ones that survive, and they have some amount of discipline when it comes to growth. And there's kind of a mismatch in terms of mental models for people that try to port over the lessons that they directly learned from tech into an industry which is highly cyclical in general as well.
Yeah. Yeah, I agree with that. I harbor an optimistic hope that one day it won't be as cyclical. We'll see if that ever plays out. I think it's about the number of users. Like if you have the same
Mm,
100,000 active users, the number is debatable. It's going to be cyclical because it's kind of like they get wealth effect. They get a wealth effect injection. They all speculate. The entire system is reflexive, and like right now we're in reflexive up, where like just token prices going up make KPIs go up, and KPIs going up make token prices go up. But that doesn't have to be that way if we get real adoption and real customers, right? If
yeah.
we're going to if we're going from 100,000 to a million to 5 million to 10 million users, like in the article that we talked about at the beginning, we're talking about 8 billion users. If you actually get on that curve of expansion, then it's not going to feel as cyclical, right? It's going to feel,
Mm,
it's going to be straight up for revenue for the industry as a whole. That doesn't mean it'll be straight up for revenue for every company because there's still competition. But that's my secret optimistic hope that I harbor, that we can get on that trend at some point. It's not super cycle for like L1s. It's super cycle for revenue super cycle.
applications and revenue generating. Yeah. Um, I've got a question for you on the fundamentals piece. So, how would you distinguish in between, from an investing standpoint, in between a protocol that has a good business but a bad token? So,
Yeah.
you see this very often, right? Where actually there are protocols which are cash flowing and making a lot of money, and it could be now, some of these protocols are doing well, but like the Aves of the world, the makers of the world, etc. But sometimes you see these charts of revenue and fees that are being generated going up only, but the token is doing poorly for one reason or another.
Yeah.
So I know in the past you've worked pretty hands on with teams in terms of building out their tokenomics model. So how do you distinguish between good project cash flowing but bad token?
I mean, that's like the ideal situation for us. If someone has a
Mm,
really good business, it's trading cheap, and the token doesn't work because this token can be, it's easier to fix a good business bad token than it is to fix a bad business good token
mm,
from a long-term perspective. Um, if the business is doing well and the token's not going up, there's kind of two buckets I put that in. One, it was overvalued to begin with. So like if you're trading at 1,000 times earnings and then earnings 10x, and you're trading at 100, there's no reason the token needs to move, right? It can just stay
mm.
flat because people paid too much for the token. People paid too much for the earnings, right? That's just part of life. It happens in every market. But I think the more common cases where um, there's no value accrual, there's not the right cap table, and there's not the right communication with shareholders around like token versus equity, because liquid funds for the most part do not invest in tokens that have an equity structure that accrues earnings. right?
Yeah.
Because you're kind of in the back seat there with no legal protections. So, one good example of this is actually Metaplex. They had an incredible token transition over the past cycle. They kind of raised from a lot of VCs, some good VCs, but also like FTX, Michael Jordan, all the celebrities, and the token was down like 90% a few months after. And they were like in shambles. There was no value accrual to the token. There was no kind of, there was a few good holders, but for the most part, it was kind of bad holders on the token side. And bad holders just means like people who don't really like to hold tokens for more than a few months.
Mm.
And there was no story for what MPLX would do, right? But the team that they're now is a fantastic team. They kind of realized that, and a few funds, including a shout out to Modular, who first discovered this, realized that this was like one of the highest quality businesses in the industry, right? They have 99% share of all NFTs minted on Solana and all tokens minted on Solana. So every time you trade a token on Radium, you pay, or you mint a token on Radium, you pay a fee to Metaplex. Every time you mint an NFT, you pay a fee to Metaplex. And that's true across all SVM chains, not
Mm.
only Solana mainnet. So it's basically like a pure play bet on SVM KPIs, which is like everyone's looking for that, right? And it was trading at like 3 times cash flow at the time. So what that process looked like was, one, uncovering the token, talking to the team, saying like, hey, are you willing to say no cash goes to equity, like definitively, you know, and legally, and then also implement a buyback. Why a buyback? Not because of capital allocation, and this goes back to our other conversation, but to signal to people that the token is the holder of the DCF,
Mm.
right? Just purely on signal value. Um, so they started doing that, implementing it. Eventually, more and more like good liquid funds came in, and this kind of peaked earlier this year when the FTX estate sold a huge portion of supply to 10 good funds that just took it off the market immediately. They didn't even have to hit the market, like hit the charts with it. And now the Metaplex team is in a situation where the token clearly accrues value. They've been buying back token for well over a year. And the team also gets to communicate with like long-term oriented holders about its plans. So we all talk to the team. They kind of tell us what the plans are. They get pretty good feedback, good BD, like good help on BD, good support. And that's where I think every token wants to get to.
Mm.
But where most tokens are today is kind of like you launch some gamified models. I hate gamified token models. Your VC sold, because it's 1 or 2 years later, like post unlock. The people who hold your token are in the Discord. Nothing against people in the Discord, but it's often not the best token holders. Um, and you have no support on liquid markets. You have no support, and you're still like on the second inning of your business creation or business building.
Yeah, one thing that I've always thought is a little bit silly about how crypto treats holders is there's this idea of community good, VCs/funds bad, and whoever is a good holder is just someone that has long-term conviction in your project and is going to hold it for a while and not be,
Yeah.
a mercenary and sell. And there, just because you're, in the trenches and in the Discord does not mean that you're necessarily a good holder for that project, right? Because you're not associated with a VC. If you're going to dump, you're going to dump.
Yeah.
So
Yeah. If you're in the trench, if you're in the Discord for a month, you're a bad holder, no matter
right.
who you are, VC or community.
Walk me through from the perspective of a liquid token investor, how you think about the the projects where there's an equity component and a token component. So you described that below. So
Yeah.
you mentioned you don't even touch those sorts of, like, Uniswap would
No.
kind of be the
I
canonical example of this, right? Where there's the
I
wallet
would
and the front
love,
end. Yeah.
yeah, I would love to hold equity in Uniswap Labs. I think it's a
Mm.
fantastic business. I think we can talk about moats later. It has some of the strongest moats in the industry. I love what they're building with Uniswap X, with hooks. Like, it's a business that I look at. It's right in the middle of our thesis, and I say I would love to hold the right component that can benefit from this growth. Great team,
Mm.
but that component is equity in Uniswap Labs. The token has been treated as as a second class citizen, and it will be, right? Because what's happened is the token holders are people around the world, and people around the world who have bought over multiple years. There's been a lot of turnover, and the labs component is the team and the VCs that backed it. So there's this kind of what we call the backyard test. If you have an equity component, if you have equity that's held by the team and your closest VCs, and you have a token that's held by people around the world, and you find $100 million in the backyard, or $1 billion in the backyard, which is more like what the fee switch was on Uniswap.
Mm.
Um, who does it go to? Right? Just natural incentives. It goes to kind of you and your backers, not random people on the internet. So whenever we see that there's a risk of an equity component that can accrue value, we just stay away because we know that it's at some point, a lot of the best returns come from the things you don't expect, right? A new product line, Amazon's business is built on AWS, right? If
Mm.
Amazon had equity in a token, equity would have gotten AWS and the token would have gotten like the book business.
How do you think about this on a long-term time horizon, Felipe? One way that I started to just conceptualize tokens in general, and it kind of goes to your piece about internet finance, is just being the capital markets for the internet. And the thing about the internet is that it's global and that it's got massive scale. And one advantage that I could see for launching a token versus something like the equity in something like Uniswap Labs is, Uniswap Labs has access to private US private capital markets, which is still a very large
Yeah.
market, but over time I could see the internet capital market dwarfing that in terms of its size.
Yeah.
There's another component too that I think tokens get. You know, this is another old subject of debate here that I'm bringing up all the old Blockworks classics for you here to get your opinions on. But I think all else being equal, equity versus a token, right? If you have a company that's worth $100 million and one of its, got a token that's trading at 100 million market cap or FDV, and then there's $100 million equity valuation, the token almost should be worth more because it's liquid today, right? There's got to be some sort of premium for that. And so,
Yeah.
I hear you that there's almost like you're kind of making like a capital stack question, right? Like it's who gets the money if who gets paid out first. But also I do wonder if over time, even if you don't get additional investor protections for token holders, just the liquidity sort of idea and being the liquidity premium ends up eclipsing that. I don't know. What do you think
Liquid.
about that?
Yeah. It's two opposing forces, right? Because liquidity is incredible.
Mm-hmm.
Um, liquidity is incredible. We're a fund that holds for 2 to 4 years. We don't really sell companies unless our thesis is wrong or we realize the team isn't who we thought it was. Um, but even now we benefit from liquidity in incredible ways, right? Like you can buy more of a token if it's below a certain threshold. You can receive capital and size into your positions and keep your same kind of portfolio weights. And you can make these little adjustments around your portfolio that I think that really add up over time.
Mm.
So like if you make a few small 1% changes over, a couple times a month over 2 years, your portfolio looks completely different at the end of those 2 years than it did at the beginning. And that really impacts returns. Like think about how narrative shift and how much you would have in different ecosystems based on when you started as an illiquid fund, right? Um, that's all a long way of saying liquidity really matters. It's worth a premium, definitely. Um, but the shareholder protections matter more to us as long-term holders. I think once you have shareholder protections, which we think will come again in this decade for tokens, then they're worth more because then you have the same protections and you have liquidity. But right now it's a matter of trading those two off from each other, and I just think the trade-off favors the kind of legal protections in the case where there's two. I think in the case where there's only one, let's go back to banana gun for a second.
Mm.
There's only one token there, right? There's no equity. There's no equity component. Same with Metaplex. One token, no equity component. In both of those cases, the team owns a ton of token. And in the case of banana gun, they're locked up for 8 years. Metaplex also has a
Wow.
long lockup. So if you have like a long lockup, the team owns a ton of token, and the VCs that backed own token, not equity shares, and equity shares have been like professed to be worthless or just like a lab entity that funds operations many times, then I think you prefer the token, right? Then the token's good. But it's
Mm,
all about like you have to rely on incentives when as long as you don't have legal protections. And hopefully
right.
soon we'll have both. On that point, just like one quick data point is tokens definitely have a higher cost of capital than VC equity.
Yeah.
Like if we went to LPs and we were like, we're gonna make 2 to 3 times over 7 years, they'd be like, get the hell out. I can make that on VC.
Mm.
And that just shows you kind of what the market's decided on that question, at least under the current regime. But if you don't mind, Mike, there's one thing that you mentioned that we want to hit on, which
Yeah.
is internet finance and it encompassing all assets. There's one question that I get a lot from people when I kind of describe this system or did in the past, which is why would that happen? Like, why would a hotel owner in Indonesia raise money on the internet as opposed to going to her local banking system? Or why would a mid-market private equity fund in the US or mid-market company in the US go to the internet instead of using private equity funds that are great and like established? And I think that's like one of the most um, like underappreciated points about this idea of a global internet financial system is that you have auction network effects, right? Auctions have this winner take all dynamic where if you're going to go sell a Sega, like you're going to go to eBay because you know that's where that's where most Sega buyers live, and and the buyers are there because they know that's where most Sega sellers live as well, right? And like one incremental bidder is worth a lot to both sides. So over time, if we can really accomplish this, like dream of getting a lot of the world's financial activity on chain, it will become the lowest cost of capital place for people to go and raise funds just by the nature of auction network effects, right? The Indonesian hotel owner is most likely to find a Dubai fund that has a 6% cost of capital on the internet than it is through its kind of local banking system.
Yeah, it just makes funds compete more, right? Like it just makes everyone compete on their cost of capital more. And yeah, the cost of capital point is also really interesting. It's why the first season of Bell Curve ever was actually on um, fixed rate borrow lend and bringing some form of
Yeah,
debt on chain, which still makes sense to me. I think there are a lot of reasons why we're way too early in discussing that, but it's still a very interesting concept to me in general.
yeah,
And one concept that I wanted to poke at you at, Felipe, because I think you've done a really good job of fleshing this out with some very specific examples, is the concept of moats within crypto. And
yeah,
I'm very interested in this because people talk crypto is open source, right? It's like open source software. It's very cool. There's this idea of forking, and I think people have this embedded idea that you can never really charge fees because someone's just going to fork your code base and charge a lower fee. But we haven't really seen an enormous amount of that. And you've taken this almost kind of Porter's five forces framework and applied it to kind of taken some of the classical ideas of how you build a moat and applied it to some crypto examples. So can you just talk about how you think about moats in general, especially
yeah.
around maybe DeFi protocols?
Of course, yeah. Yeah, I think this is, by the way, the most valuable alpha that people are not thinking about right now. Like moats are the bread and butter of long-term investing. If you're a long-term investor, you're thinking about moats all day. And I don't see much discourse around that in kind of CT. So I'm happy you brought it up. Yeah, we're taking kind of the traditional Porter's Five Forces, Helmer's Seven Powers view and applying it to crypto. IP has been a moat for people in the past, but it's not one of the primary moats that businesses have used, right? Like IP, even though you can't always copy it directly, you can hire someone's engineer and figure it out in house. And like, I mean, you've seen that since ChatGPT came out, how many new GPTs there are, like discoveries have a way of getting replicated across industries quickly, even if it isn't open source. Um, the moats end up being more around economies of scale and network effects and coordinated resources, and we put out a piece on that. But I think the just to keep it pithy, the 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 most common moats in crypto are kind of like four buckets: economies of scale, network effects, coordinated resources, and branding. On branding, people like to say like, oh, I'm not going to go trade on X and Y because I like the brand and pay more. I'm not going to go trade on Uniswap and pay more because I like the brand. That was a big argument 2 years ago. Well, it turns out people are willing to do that and pay a lot, right? Like Uniswap trade charges 25 basis points. That's a big number on front end fees, and Coinbase charges above 1% on its UI. But the more important branding moat is on cost of capital for TBL products. If you're a fund and you're going to lend to a borrow lend product to get leverage, and Aave is offering you 7, and some startup is offering you 9, there's no chance on earth that you're going to take the startup risk on 9, because it's 2 points on your capital. It might be for 3 to 6 months, so cut that in half or by a quarter. Um, and if you lose the money, you're fired, right? Like, you're the biggest idiot in the world for trying out some new protocol to save 2% over 6 months and losing your capital. So branding, that's how Camino really built its product on Solana. Marius is like well known in the community to be a super paranoid risk manager, and people started trusting Camino and depositing there, and and simply because it had this brand of risk management. And that's true for all TVL products. Nobody wants to lose their money on an exploit, uh, especially not funds, to have to go and report that to external parties. And I think over time, funds will be more and more of this ecosystem.
Yeah, the brand one is so interesting to me because it's this really funny dichotomy in crypto where everyone loves yield, right? Everyone
Yeah.
loves yield. And because this is a retail driven market, you see these crazy yields that you would never see in TradFi. And the reason you'd never see them is because TradFi is probably a little bit smarter than crypto, more institutional. And there's an understanding that, the risk reward understanding is baked in. So if you're seeing a yield that 150%, you're taking an enormous amount of risk. You're not necessarily going to do that. And so it's very difficult in crypto. There's this kind of, if you are established and an incumbent, you want to compete on brand and security, which I think is probably the right way to do it in the long run. But if you're an upstart, you don't have that lendiness or that security or that brand. And so the only lever you really have to pull in many cases is yield. And
Yeah.
so, I would love to just get a sense for how you think about, almost if you were in the driver's seat of, newer protocols that are competing with the Aaves of the world, right? On that something has like the just use Aave kind of lendiness. Um, because if you offer more yield, you might inherently be seen as risky, but that's actually what the market might want right now. Like, how do you think about like the yield versus brand competition when it comes to DeFi?
So I think people who have tried to compete purely on yield have not done that well. Like, fork and just increase yield. I can't think of a single example that's like dominated, that now dominates market share. Like Sushi Swap, all the Aave forks, like they have their moment, but they don't. None of them have replaced the king in the sector. I think the way to compete is really on design space. So right now on the Aave example, I think that Morpho and Euler are going to give Aave a run for their money over the next 5 years here, or 2 years here, if you want to make a shorter prediction, because they're competing on design space and actually doing something, a counter positioning, right? A counter positioning is something that you do in business that your competitor cannot do without destroying its business. The classic example is like Netflix sending out DVDs, is a counter positioning to uh, remind me the name of the video rental store, Blockbuster, because they have physical stores. They can't sell DVDs without destroying their business. Morpho and Euler are kind of doing that to Aave. Aave has this monolithic pool. They're known as good risk managers. The whole point is all the liquidity is in this one pool, and that's kind of the moat. And we can, that's kind of the network effect moat for them. And Morpho and Aave are starting a modular lending and saying, hey, we're infrastructure. We're going to allow much riskier vaults to be created by risk managers. So now you're not trusting, Aave's governance, which has been quite good, but you're trusting each individual risk manager. You're trusting Gauntlet, you're trusting RE7, you're trusting Steakhouse. And by moving the trust one level higher on the stack, we allow for experimentation, and we allow for, lending on long tail assets, creation of structured products that might be too risky for Aave, um, and all this kind of interesting financial innovation that will result in some of these pools really taking a lot of TVL and taking share from Aave. The reason Aave can't do that is because they have this kind of one of n failure mode, right? If Aave puts on a collateral type that fails, the whole pool failed, the whole business is over. Like, they had UST. Luckily, they had like 10 million of UST and the business survived and they had the insurance protocol. But like if they, add Athena and Athena, I don't think it's going to happen. But if Athena were to go to zero for whatever reason, like Aave is over as a business, right? Whereas Euler and Morpho can add any collateral they want, any, not within reason right now, but they can add any long tail asset. And if it fails, if the vault fails, then that risk manager lost its reputation and it won't get capital anymore. But the underlying infrastructure can survive past that because it was unopinionated to begin with. So I think that's
Mm,
like they're competing on design space. They're not competing on yield. And that's where we've seen things do well in the space.
mm. Yeah, it's actually Coinbase is another interesting example of this. You had a couple of you listed Coinbase in the economies of scale, being able to amortize their costs across a larger base. But the other thing that they have is brand as well.
Yeah.
And Coinbase has been able to charge pretty high fees for an extremely long
Yeah.
period of time. This has been the knock that those high fees that Coinbase has been able to charge to their retail customer base are going to go away. We are 12 years in to Coinbase as a company, and there's no
I don't think it's going away.
those fees
I
are.
think it's going to
Yeah,
go.
I don't think.
I think it's going to get worse. I think that what they're going to do is become an aggregator, where this like aggregation theory is like the idea that a business owns the customer to such an extent where they can make everybody else just a backend provider. So like Spotify owns the customer. Go ahead.
I love this. I love this. I've talked about aggregation theory. I went back and looked this up.
Yeah.
There's an old episode that we did probably a year and a half ago where we talked about aggregation theory and smiling curves. And yeah, there's
Yeah.
so much. Maybe it's because of our Bitcoin roots that there are so many supply oriented demand theses or sorry, investment theses when it comes to crypto. When people talk about this scarce supply as if that means something has to go up, and you're focused on the tail end of the value chain as opposed to the relationship with the customer. And it feels
Yeah.
like to me that's a really sticky and important component. And there just aren't that many businesses that have a lot of customers in crypto yet. And I actually think those customers are much more sticky than we might give them credit
Yeah.
for. In traditional financial services, brokerage customers famously never move. Once you sign up with a brokerage or a bank account, you just never move. That's why banks are willing to pay such high customer acquisition costs. And I wonder if it's the same in crypto a little bit too. So I agree with you. I think
They're
Coinbase is
sticky. Yeah.
positioned so
Good.
interestingly.
Yeah.
No,
They're
sorry.
sticky and they're priced inelastic. You can charge
Yeah.
them fees. That's why all these junk fees. They just can't. They keep adding fees and people don't leave. So over time they accumulate. That's why Coinbase can keep charging 1%. Why I would do the same thing if I were them. And on the aggregator side, for the audience, like Spotify's an aggregator, they get to treat musicians basically however they want, right? Only someone like Taylor Swift can debate Spotify. Everybody else, like your favorite band, Audioslave, they have no negotiating leverage at all with Spotify, right? And Coinbase, I think, is entering that position, especially if regulations open up and they can expand further, where they can treat every DeFi app the way that Spotify treats artists and say, hey, X borrow lend protocol, Camino, like you want to be on Coinbase, we'll rope you in, but we're keeping 80% of the yield. What are you gonna say? It's like 10 million new customers or 50 million new customers, maybe down the line. You're gonna say yes every time, and they're gonna keep the lion's share of profits. And there's a case where they keep the lion's share of profits from DeFi in general because they have there's multiple players in the back end, and they have the kind of holy customer and can dictate terms. So there's two aggregators in crypto right now, Coinbase and Binance, and they're making more money than everybody else combined by an order of magnitude. So I think that's definitely the most profitable spot to be in.
I might be going way out on a limb here, so if you have no opinions, that's totally fine. But what do you think about Robinhood as a potential competitor there? So, if you look up something like Robinhood, they have this mass. It just feels to me like they should have an interesting wedge into this market because, like all right. A couple of years ago, there's a big push for a bunch of DeFi protocols to launch stable coins,
Yeah,
some of which were successful, some of which were much less successful. And I think if you look at the ones that have been successful, usually you have to have some form of distribution. And I think part of the reason why USDC ended up taking off was the Coinbase distribution angle. And part of the reason why Base is, I think you could just say the most successful L2 at this point. It's got the most TVL, probably the most activity at this point. It's just because it's got this massive user base. And like when you look at other companies that are poised to potentially do the same thing, Robinhood looks pretty similar. If you look at the amount of daily active users,
Yeah.
Robinhood actually has more than Coinbase. It's extremely retail oriented. I could imagine them spinning up an L2 and potentially partnering someone with like a stablecoin issuer and running basically the same playbook that Coinbase
Yeah.
has, and it would be wildly underpriced. So what are your thoughts on Robinhood as a competitor here?
So no opinion until you ask the question right now. But
Mm,
like in the vein of what we're thinking, if I were Robinhood and I was given a blank check on regulations, I would just go to Jupiter and pump and say, hey, you guys are going to build a, I'm going to build you guys in. You're going to do all the work and you're going to give me a rebate for 80% of the profits. And they'll say
yeah.
yes, right?
Yeah, because they don't have the other thing about, I mean, Robinhood has actually built out a pretty impressive crypto team. It's something that I didn't
Yeah.
really understand until recently, but it's not the same level of nativity that Coinbase or Binance would be for
Yeah.
sure. Yeah.
But the customers are, I mean, it's already selected for the most aggressive retail customers who are most likely to want to trade meme coins. So, I mean, they have all the leverage there if they decide to come into the space, just based on the same kind of vein of thinking. The
Mm.
other kind of moat I mean, one just really interesting moat that I haven't seen much outside of crypto is there's this idea of a cornered resource moat. And like the classic examples are like Saudi Aramco has the cheapest oil in the world, right? So they can compete. They can always compete better. They can always underprice everybody because it takes $20 to get their oil out of the ground. Sorry, like $4 to get their oil out of the ground, and everybody else is way above 20, right? Or like De Beers had the best diamond repositories in the world. It's not a very common mode to see, but in crypto you see it a lot with trapped capital, which is actually kind of funny. So like MakerDAO has over $1 billion of trapped DAI, which is DAI that's never moved, or hasn't moved over the past 5 years for different reasons, and it doesn't come into the staking module. So they can offer higher rates to DAI holders because there is a whole portion of the DAI pool that isn't getting paid out because it doesn't move. And you have the same thing, the famous like Uniswap ETH USDC pool. Why don't they move if they have such drastic lever? A lot of those accounts haven't moved in years, right? So a lot of it's just dead capital providing liquidity at slightly suboptimal rates, but it's not moving. And a new competitor can't get that dead capital, right? It takes years to accumulate. Like third example is like on Radium, you launch a meme coin, you burn the LP. So with Popcat, all of these memes, if they endure for any period of time, like you're trading them on Radium because they don't need to pay a cost of capital there. They have trapped capital that's completely insensitive to what they're paying, and it's just a really good moat because an upstart cannot replicate that, right? No matter how much VC funding you get, you can't replicate that.
Super interesting. Do you think that there is, so the DAI, my understanding of the dead capital behind DAI is it's a bunch of retail depositors who've just lost access to their wallets or forgotten about it or died or
Yeah,
whatever. The Uniswap one is interesting. I've talked about it many times on the show. It's my favorite conspiracy theory about who that actually is. But my understanding there is that it's actually a small amount of wallets, very well funded, very professional, etc. So um, I mean, I guess I put myself in the position of the founders of these protocols as well. And
yeah,
how safe do I feel resting on that assumption that capital is never going to move? Because one day
yeah.
it just could. And if that's my moat, that could go away almost overnight. But yeah, it's a super interesting
Well,
concept.
in
I've
the
never
case of
heard anyone
Uniswap, I
really
think
articulate it.
I think they have like 10 moats, by the way, on Uniswap side.
Yeah, they do.
There's just like one interesting one.
Uniswap is one of the more interesting businesses in all of crypto, in my opinion.
Yeah,
I mean, I know they've got the labs equity versus the token, et cetera. But man, when you just think about what they've done, and now a lot of the stuff a lot of the moves and what they've shipped makes a lot of sense to me. So there's the wallet, which is actually a little bit
yeah,
of a sleeper hit. Like they've got a lot of people that are using that wallet. The UX, if you haven't messed around with it lately, is quite good. They've still got the
yeah,
front end that many retail people trade through, and they're taking I forget, it's like 15 basis points or something like that, or a
yeah.
25 basis point
I
on
thought it was 25.
25. Yeah, that go through that. And then with V4, they're just going to have, and Unichain, they're just going to have a bunch of different AMM designers competing for, to build the most, lever optimized or, whatever it is, hooks on their own sort of L2 layer, right, where they can extract another layer of fees. I mean, it's just genius. It's
It's
great. I
genius.
mean,
And
yeah,
the hooks, the hooks are my favorite one because they're kind of secretly building in these massive switching costs, which is another
yeah,
one of the costing moats into their business, right? If you build your business on a hook, you're not moving. Like, unless Uniswap takes all of your profit, you're staying put because you like a move would be a huge amount of effort and risk and like disruption for your customers, and it might not even go well. So like if Uniswap decides to charge you, like raise the price they're charging you as a builder, for whatever reason, like indirectly, directly through rebates, whatever, you're kind of stuck there, right? So
mm.
they're building this little feudal kingdom where they're at the top of the hook stack. And I'm saying that as a positive. Like I see it as a brilliant kind of moat slash business move on their part.
You know what else is another interesting moat is brand for Uniswap, actually, because
Yeah.
part of the reason to build a hook as opposed to designing your own AMM, it's a couple of things. It's one, in theory, I think you might be looking for some of that order flow. I'm not
Yeah.
sure what the routing is going to look like in between the Uniswap's front ends and whatever the AMMs that end up getting built are. But another one is security, right? So they've got a very clever sort of model where you can inherit a lot of the security and they're running a $15 million bug bounty, right, on V4. It's going to be the most tested, eyes on code base in all of crypto.
Yeah.
And yeah, that's part of the reason why why design your own AMM if you can kind of have the this very tested nice code base that you're building on top of. So
Yeah.
you know
And
what?
another
Have you ever
sleep.
listened to you strike me as a guy who might have listened to Acquired, the podcast.
Yeah. Yeah, I have a few times.
Uniswap might be only one of the protocols in crypto that you could do a full Acquired episode on and like break down all of the different components of the business and how they all fit together. And yeah, it's
Yeah.
quite
That's actually a great idea.
good.
You should do it,
Hmm.
you know.
Yeah, maybe we'll something to build up to towards the end of the year. But
The other sleeper is Uniswap X. You know, I don't know if we mentioned we're a fully on-chain fund. We have been since day one, and like part of that was just kind of skinning the game and dog fooding the industry as we're kind of building in it. Um, but one thing that we realized, kind of being an on-chain fund, like a fully on-chain fund, is how much easier the ops are. Like operations for a fund are hard and often
Yeah,
require multiple people. But when you're doing them on chain, all you need to do is send your nav, like your nav administrator or like your administrator, your wallets, and they'll ask you a few questions and it's done because they have a full record that's verified of all of your transactions, which is usually the hard part. It's like that's usually the bottleneck is getting everything you've done, all the contracts you've signed, and like talking about each one. Here it's like, here you go, dude. Don't ask me any questions, right? Again,
mm,
they do, but so like all else equal. If I can trade with Wintermute on Uniswap X or trade with them directly, and it's the same price, I'll pick Uniswap X or Camino Swap, same product, any day of the week, basically.
yeah. Felipe, we in our final couple minutes here, and unfortunately have to wind down. I'm sure we could go for a couple other hours. Maybe we'll do our Uniswap Acquired episode, the two of us at some point. But yeah, any closing thought? Anything that we haven't fully addressed yet, or closing thoughts on open internet, DeFi, moats, etc. that you want to leave listeners with?
Maybe I'll just like do a little pitch to founders on this last graph that shows kind of the disruptible market on the
Mm,
piece.
mm,
Um, the idea is like people, I think in general, we think people are playing too many short-term games in the industry, and like the
yeah,
real strategy is survive for the big prize. We run our favorite thing, or my favorite thing now with ChatGPT is to use Canva to run like Monte Carlos as a joke. We run them all the time, showing like if you have this industry that's growing with massive volatility and a lot of failure modes, what's the optimal strategy? And it's always just get a little bit better each year and survive,
yeah,
right? And I think that plays into our like eye on the prize idea. If you look at financial services and the amount of revenue in the industry, it's a 5,000x revenue opportunity for crypto right now, just on financial services, only assuming that the market stays put where we think it's probably going to grow, right? So that's like there's a massive pie here. I think we like to invest in people who build for the long term. We're building for the long term. Um, and it sounds obvious, but I think there's a lot of kind of distraction and sound and fury in the space that trying to like pulls you gravitationally towards thinking short term or taking undue risk. And I think we'd say, eye on the prize.
Agreed. All right, well said, Felipe. Well, really appreciate it, man. Thank you for coming on the pod. If folks want to find out more about the work that you do with Theia, or follow you on Twitter, or whatever it is, what's the best way for them to learn more?
Best way would be at Theia Research. I publish everything there, and everything we do as a firm, I also publish there.
Cool. All right, my friend. Well, appreciate the time. This is a fascinating conversation. We'll have to do it again sometime soon.
All right, thanks, Mike. Appreciate it. Take care.